All right, looks like I am live again. So, a lot of interesting things out today in the news. Yesterday, we had Jerome Powell do, I guess, a webinar with the Peterson Institute and talk about negative interest rate policy, that they do not want to do it, for now, even though a lot of Wall Street traders are betting even more so on negative interest rates in the not too distant future. So today we had the official Fed balance sheet update. We also had the jobless claims numbers. The amount of jobless claims is absolutely enormous in 8 weeks or 2 months. 36 million Americans have filed for jobless claims. There are a lot of Americans that are still on the jobless claims for many weeks, if not over a month already. It's over 20 million Americans, so they are not coming off the jobless claims. Now, some of that is because a lot of them are, well, at least some of them, depending upon the state they live in, making more money on unemployment than they are by working. I've heard anecdotally entrepreneurs and small business owners telling me that their employees, well, mostly small business owners, telling me that their employees, some of them, are making $600 more per week watching porn or playing video games or watching YouTube videos or swiping right on dating apps trying to get some hookups in, or paying someone's bills on OnlyFans.com, than actually trying to figure out how to make more money for themselves and better themselves and get back to work. So there are a lot of jobless claims. Apparently, there's another article out where it could get even worse because a lot of firms now are not getting the SBA loans. The SBA loan deadline is coming up, and we may see even more firms start to go under. We've already seen a good amount of bankruptcies, but there could be even more in the not too distant future. The other update today was the Fed's official balance sheet. It went up over $200 billion in the last week officially. Went up the exact amount officially is because unofficially that's where the real fireworks are off balance sheet in special purpose vehicles and currency swap lines and a bunch of other shenanigans. The Fed's official balance sheet went up in the last week over $212 billion. So the pace is back. In the last couple weeks, the balance sheet had dropped. The pace of the balance sheet had gone down from around $300 billion per week in growth down to about $70 billion per week in growth, a little over $70 billion. I think it was $74 billion. And now we're back up again to $212 billion per week. This probably has to do, my educated guess, with the amount of spending that Congress is planning. Also, how the U.S. Treasury issued the guidance for Q2, their funding needs of $3 trillion, and then for Q3, they're going to need at least $667 billion. Now, normally the federal government underestimates stuff like this, so this is probably going to be even more than $3 trillion. We're looking at least $5 trillion budget deficits for 2020. That's how crazy things are. This is the new normal for now because of the cash flow problem. The real economy is not generating cash flows. That means the government's not collecting the normal amounts of tax revenues, and people are not able to pay their bills. People are not doing productive economic activity. So they're not getting, small businesses are not getting cash flows. People are not getting cash flows to pay their bills. So instead, people are filing for jobless claims. But the Keynesians are saying that that's good. And the Democrats in Congress want to give people $2,000 per person per month checks, which would be an additional about almost $8 trillion in more spending in a full calendar year for 12 months. That's nuts. Hopefully we don't get to that, but honestly, at this point, nothing surprises me anymore. It really depends on the dollar and how much they think that they can get away with, because Congress was talking. Initially, the bailout, I think, for the states and municipalities, the initial numbers over the last month were $500 billion. And then within a couple weeks after that, it got to $1 trillion. And then just this week now, the new numbers for the bailout package that Congress is talking about, this next stimulus/bailout package, it's more a bailout package. It's not stimulating anything. I mean, it's growing the debt. People are not, there's no growth there's no real growth in anything. So it's not stimulating anything. But I think now the amount has ballooned because they want to they're already talking about sending even more checks, even though most people haven't even gotten their $1,200 stimulus checks yet. They're talking about additional checks. So that number has gotten to, the headline number I've seen is $3 trillion. So it's gone from $500 billion About a month ago, a couple weeks ago, it was about a trillion, and now here we are. This week, it's 3 trillion they're talking about. We'll see what the exact number is, but it's just nuts. I think they have so many more of these spending programs planned. I'm sure they're already discussing infrastructure spending bills, additional stimulus checks, potentially canceling student loan debt. It's just insane, the spending. So let me talk now that we've talked about the Fed's official balance sheet. I have the Fed's official balance sheet a little bit more perspective there with Brad Houston, who I follow on Twitter. So that's it's almost 7 trillion. They've added 2.8 trillion in the last 2.5 months, a 68% increase in just 10 weeks. This is only 900 billion shy than what the Fed added in 6 years over 3 rounds of QE after the 2008 global financial crisis. So that's how crazy things are. Okay, so let's talk about Jerome Powell's comments from yesterday on this webinar. I guess he's using Zoom. Federal Reserve Chair Jerome Powell made 2 things clear. I'm reading the Bloomberg article with the title there from Brian Chapata from yesterday, May 13th. Powell slams door on Trump's negative rates gift, because President Trump has been tweeting about how negative interest rates are a gift. No, they are not. They destroy economic calculation in the real economy. They do immense damage. Let me just play, I'm getting a little off track here. I'm not using notes. Let me just play this short for a couple minutes Bloomberg clip. I think it's really good. It's with a professional bond fund manager, Jimmy Dunn, vice chair and senior managing principal of financial services at Piper Sandler, talking about negative interest rate policy and how bad it is for capitalism and the economy. Here we go.
Chairman Jay Powell seemingly put to bed the idea of negative interest rates, but the president is going to hammer that home, we know. Is there a chance we do see negative rates in the U.S.?
Well, I certainly hope not. I was relieved and not surprised by Chairman Powell's comments. I mean, negative rates are destructive to the first principle of capitalism. I mean, it's a terrible idea. He was very gentle about it, but he said it hasn't really worked in other places. You don't have to look far. Japan, Germany, where this idea is not a good one. It's just insane. I mean, the idea that, okay, here, borrow money and I'll pay you for it is just fundamentally wrong. And, you have a lot of academics discussing it, but it makes no sense on Main Street. And it is a very scary proposition that has never proven to work well anywhere, and I couldn't be more against it. And I don't think the chairman will be swayed by it at all. He's got an arsenal. He'll deal with it, and the Fed will do everything it can, through this crisis, which is really a crisis.
Even with rates as low as they are, though, Jimmy, never mind going negative, they're already sort of razor thin, above zero. How are banks, boutique investment banks, and the regionals faring?
Well, banks are really challenged at this point in time because, as you point out, it's bad enough as it is. We have a flat, very low interest rate environment, and obviously a positively sloped yield curve is where a bank can really perform the best. So they're going to be challenged from their income statement on basically where low rates are and have been, and it has been further accentuated. If it was to go negative, then it would be just disastrous, really, in my opinion. But the other reality is we don't know for how long and how deep and how problematic this is going to be, but we know it's going to be bad. And the reality of it is, unlike '08, everybody keeps referring to '08. This has nothing to do with '08. '08 was created because there was too much credit, too much of an extension in credit, and not just the banks but other lenders were really at the core and caused the problem by this excess credit. This is just the opposite. The banks very well may be a path out and a solution to the problem. It's just that it's going to be a deep slog. And the fact that you can lose, I don't know what the number is, 20 to 40 million people for a period of time, you can pay them more where they don't work, that's just not a constructive environment. And it's banks, the bank stocks obviously have suffered dramatically. I'm a great believer that you buy banks below book and you sell them at 2.5 times book. It's a strategy that's worked for a long time. The issue now is is what is book. And obviously, I think there are real values in the banks themselves. I'm not going to name which ones, but I think there are values. It's just that you've got to reacquaint yourself to that may be the real book. And it isn't the idea that 70% book, so boy, they're going to go back to book. That's not the case. I think the reality of it is this is going to be a very difficult slog, and I think the banks can be part of the solution to get out of it, frankly.
Well, let's.
Okay, that's enough for that. So Jerome Powell also said that official unemployment, could get to 40% this week. So there was a journalist who quoted him on that. I have the tweet screenshotted in the Wall Street for Main Street Facebook group. I don't have it there on your screen. I wanted to show the chart with how traders are betting on negative interest rates in 2021. Alan Greenspan, for those of you, I covered this last year who are new to my channel, but I covered this last year in September 2019. Alan Greenspan, former Fed chairman, did interviews saying, quote, "It is only a matter of time before negative interest rates spread to the US." However, I don't know if I fully agree with that, because I think a lot of the more experienced Fed officials, the ones who actually have some private sector experience like Jerome Powell, realize that economic devastation in the real economy, how negative interest rates destroy economic calculation. They hurt investors, they hurt businessmen. You cannot do discounted cash flow analysis, net present value, without a risk-free return. So with a positive interest rates. So if you go negative and you start trying to force, right now central banks are doing, the major ones are doing yield control, they're doing Japanification, or what the US did during World War II. They're doing that with the debt levels and controlling the yield curve. But if they try to do worse than that, negative interest rate policy, Danielle DiMartino Booth has talked about this for a while now, where the discounted cash flow formulas for firms in Japan and Europe, they broke. So when those central banks started either forcing negative interest rates or real yields went negative, they had to borrow the US Treasury formulas for discounted cash flow analysis. So if everyone goes negative, economic calculation, which is where a businessman or investor starts doing cash flow projections, whether or not an investment is good, whether or not doing a business deal or an acquisition is good, because they're projecting out the cash flows and discounting them. There is no discount to do if there's negative interest rates. So they're going to start negative interest rates will break even more things. But the reason these academic Keynesians, and this is the problem with Keynesian economics, one of the major problems, there's a lot of problems with Keynesian economics, but one of the major problems with Keynesian economics is they don't respect savings, they don't like savings, they don't believe in savings, because Keynes believed that savings was the paradox. He called it the paradox of thrift. So he believed that consumer spending is what drove the economy and economic growth. So consumer spending at all costs. Now you can consume from savings. So if you build up savings, then you can consume from savings. But Keynes did not like that. And the neo-Keynesians have taken things even further. I'm not sure if Keynes would have been in favor of negative interest rate policy. He might have thought it was preposterous, because then they would have taken his ideas even crazier further out to the extremes. But that is it's already happened in Japan and the European Union. But it's being discussed. The main people discussing negative interest rate policy are the academics. People in the real world, real businessmen, real small business owners, people on Main Street, people at the Fed who actually have private sector experience, they are not in favor of negative interest rates. So we've had people like the St. Louis Fed President James Bullard recently on May 11th. He was talking about how negative interest rates would be bad. So it's the people at the top of the Fed right now are against negative interest rates, but it's the academics, the ones who don't have any real world experience, who are in favor of it, because they want to force people to spend and not save. Why? Because we're starting to get articles that came out recently. CNN Business did an article, and there's other articles about this. This is ridiculous. I can't believe the title, by Matt Egan at CNN Business on Tuesday, May 12th. New threat to the economy. Americans are saving like it's the 1980s. So Americans are slashing their spending, hoarding cash, and shrinking their credit card debt as they fear their jobs could disappear during the global pandemic. U.S. credit card debt suddenly reversed course in March and fell by the largest percentage in more than 30 years. At the same time, savings rates climbed to levels unseen since Ronald Reagan was in the White House. The dramatic shifts in consumer behavior reflect the unprecedented turmoil in the U.S. economy caused by the global pandemic. Although caution is a logical response to that uncertainty, hunkering down also poses a major risk to the recovery in an economy dominated by consumer spending. For those of you who are not familiar, consumer spending makes up about 70% of the U.S. economy and the GDP. And this goes back to Keynesian economics, because they don't want people saving. Even if you consume from savings, they want you spending. And negative interest rate policy might be a way to try to force people to spend and not save. So people are saving. Some people are saving now, not everyone. Okay, let me read the article here from Jerome Powell. Went off on a little tangent from yesterday. Federal Reserve Chair Jerome Powell made two things clear during much anticipated remarks on Wednesday. First, fiscal policy might need to do more to combat the lasting economic damage from the global pandemic. Second, in what markets were most eager to hear, he's not about to steer the central bank down the path to negative interest rates, yet. Quote, the evidence, I added that part. The evidence on the effectiveness of negative rates is very mixed, Powell said Wednesday in a webinar hosted by the Peterson Institute for International Economics. To hammer home the point, this is not something that we're looking at. Quote, it's an unsettled area, I would call it. I would say that the real-world results are disastrous. It really hurt European banks. It really hurt Japanese banks. Japanese banks went, their cost of capital was enormous. There was a Real Vision TV interview with an expert last year. Their cost of capital for Japanese banks was enormous. And guess what Japanese banks did? Because of bad interest rate policy by the Bank of Japan and lack of being able to get income from bonds, they went and gambled on collateralized loan obligations, and those are blowing up now. Unintended consequences. These central bankers will not take responsibility for their screw-ups. It's an unsettled area, he would call it. I know that there are fans of the policy. It's almost all academics, but for now, it's not something that we're considering. We think we have a good toolkit, and that's the one thing, that's the one we'll be using. What was left unsaid, of course, is that one such fan is President Donald Trump, who tweeted on Tuesday that, quote, as long as other countries are receiving the benefits of negative rates, the U.S. should also accept the gift. Oh my God. Big numbers. Given his background in real estate and racking up debt, it's hardly a surprise that he's enamored by the concept of being paid to borrow. This wasn't the first time he has endorsed negative interest rate policy, and it certainly won't be the last. He also complains when the dollar gets too strong. Still, markets have largely been accustomed to tuning out the president's off-the-cuff musings on monetary policy. Not always. If he tweets about the dollar, he may eventually get the Fed, the Treasury, to start doing even crazier things. Recently, however, the interests of bond traders and Trump have aligned. For days, Fed funds futures, which is what the professionals bet on where interest rates are going, have been pricing in a policy rate that's below zero as soon as next year, even though current officials have widely indicated such a move is not in the cards. Here's what that looked like before Jerome Powell spoke. The hedges gained traction on May 7th, the day after Jeff Gundlach, DoubleLine Capital Chief Investment Officer Jeff Gundlach said on Twitter that pressure will build to take the Fed funds rate negative because the Treasury was borrowing so much with short-term bills. Some of those rates have already fallen below zero in secondary trading. Then Atlanta Fed President Raphael Bostic vowed the central bank would deploy its full arsenal to aid the economy and would err on providing too much support, not too little. Quote, it is really a whatever-it-takes scenario, similar to Mario Draghi, he said, echoing the famous phrase from Mario Draghi when Draghi was president of the European Central Bank. I think that statement was made in, 2013? The impulse makes some sense logically. If a trader had to bet on the direction of the Fed funds rate in the coming year, it would have to be down. As Powell made clear after last month's Federal Open Market Committee meeting, the central bank will be in no hurry to tighten monetary policy. He hinted during his remarks Wednesday that it could be a few years before the economy has truly recovered. More immediately, that's after a lot more bankruptcies on Main Street, and probably oil companies, and travel companies, and hotels, and bricks and mortar retailers, and casual sit-down dining restaurants, and lots of small businesses that did not get SBA loans or can't compete because their workers are being paid more money to not work. with unemployment checks. More immediately, U.S. unemployment is at levels not seen since the Great Depression. It would all seem to add up to Fed officials' pressure to do more. In a somewhat unusual stance for a Fed leader, Powell is imploring lawmakers to take further action rather than the central bank. Actually, all these central bankers, I don't know why this article said that, central bankers always say fiscal policy. Quote, this is the time to use the greater fiscal power of the United States. They see another to tell Congress to get its act together. Great fiscal power of the United States to do what we can to support the economy and to try to get through this with as little damage to the longer run productive capacity of the economy as possible, he said after the April FOMC meeting. The federal stimulus law has allocated some $454 billion in equity funding already for the Fed's various lending facilities. He reiterated that view on Wednesday. Additional fiscal support could be costly, but worth it if it helps avoid long-term economic damage and leaves us with a stronger recovery, Powell said at the end of his prepared remarks. This trade-off is one for our elected representatives who wields power of taxation and spending. He added later, if they raise taxes in this environment, it's going to make things even worse. But governments will probably try that anyway at some point. They also have the inflation tax, which most Americans are totally unaware of. He added later that the goal should be boosting the economy such that it's growing at a faster pace than the national debt. Powell didn't entirely erase the negative Fed funds. Say this 3 times fast. Negative Fed funds pricing. Powell didn't entirely erase the negative Fed funds pricing in futures markets. For now implies there's a chance down the road, but he slammed the door as forcefully as he could on the policy while still preserving the central bank's coveted optionality. It's not that he wants to eradicate negative interest rate bets per se, but he just doesn't want to get boxed in by the markets. Negative interest rates really, really bad for pretty much everyone, except for over-indebted governments and large corporations. Even the banks and insurance companies get killed. Pension funds get killed with negative interest rate policy. My friend Daniel Lacaille, who I've been trying to book for an interview for the next couple weeks, hopefully I'll be able to get him on soon. He's written a lot of articles about this for the Mises website, Mises Institute website, about all the damage that the negative interest rates have done to all these different industries in Europe. Dollar index is still above 100, despite Congress talking about another $3 trillion spending bill. Kevin says, thanks, Jason, for all your podcast and Patreon work. You're welcome, Kevin. I'm actually working on a number of different articles. There's a very lengthy one. I won't say what it's on. It'll be a surprise. I think you guys will like it. Also, I have a shorter one in mind. I haven't started on it yet, but it'll be about a rally in commodity prices and some of the better ways to play that with diversification. Mike asked, do I think negative interest rates are good for gold? Yes, because then you're not being paid interest rates to not hold gold. So central bank balance sheets expanding and negative interest rates are good for gold. What governments can try to do to counter this is they could try to put windfall profits tax on owners of physical gold. They can try to tax gold mines more. I doubt they will confiscate gold mines. Do governments know how to run gold mines well? I mean, look at Venezuela. I covered this in an article dealing with that war on gold. I'm not going to discuss the war on gold video. There's a over 5 hour research piece behind the paywall on my Patreon going into detail, debunking most of it. Well, pretty much all of it. And you don't have to sign up for a $5,000 per year paid newsletter. Most likely, governments will attempt to tax some of these miners more. But if they tax these miners more, investment will leave the country, which will then collapse these emerging market economies even more. See, these governments, if they tax their miners, the investment will leave. Look what happened with Ecuador. Jonathan asks, he knows negative rates is good for gold. As long as politicians don't try to tax gold too, they might try that. Is it also good for the dollar? I think the dollar's issues are separate from negative rates. It depends what the other central banks are doing, because right now, the other central banks, as crazy as all the stuff the Fed is doing, sounds, the other central banks are printing relative to their GDP. The central bank balance sheets are expanding even faster. So it depends. Currency stuff is relative. Central bank balance sheets are relative. People, currency traders are measuring this relative to GDP. So central bank balance sheets, they're comparing central bank balance sheet to GDP ratios. So if the Fed's balance sheet goes to 15 trillion, 20 trillion, 25 trillion in the next couple years, people are going to start to get very worried. We're not over 10 trillion yet. We might be in a couple months, but we're not over 10 trillion yet. So I would say it's more complicated about the dollar. There is a lot of demand for dollars because if they don't get dollars now, they're going to default. So that's what's causing demand for dollars. But then Congress can get away with even more spending and bailout programs to try to weaken the dollar. Look, I think the people at the Treasury, the Fed, Congress, Trump administration, they understand what all the bad things that happens if the dollar index and the trade weighted dollar gets even stronger. I think they understand all this now. Okay, super chat from Abbey Road. Thank you for the super chat. How much will the coming S&P 500 crash drag down gold tickers? Your Australian gold tickers doing better than USA gold royalty tickers. Why? This is only the short term. It's probably profit taking. There was probably profit taking. Some people made a lot of money buying Sandstorm Gold, Franco-Nevada, Royal Gold, Wheaton Precious Metals, Mavericks Metals, buying them when they crashed in the first week of March. If you bought Sandstorm Gold back then, it dropped below $4 a share and it went over $8. You don't think people took profits? Almost, if you're a hedge fund manager or professional money manager, you're going to take some money off the table. Even if you love the stock, you need to send out an email. You need to send out a fund document and an email to your hedge fund investors, telling them you made a lot of money off gold stocks. So there was profit taking here. So to say that Australian gold miners are going to routinely outperform the royalty and streaming companies, I think this is just probably profit taking. Look at where gold prices are in dollars. Plus the Australian government with some of the gold miners, I'm kind of worried. Look what they did to Fosterville. Look what the local province where Fosterville is located did. They put an extra tax on Fosterville. They put an extra royalty tax. I'm not an expert on Australian gold miners, though. Kirkland Lake is, in my opinion, Kirkland Lake is the best way to have Australian gold mining exposure. You get Fosterville. And then you get a couple solid Canadian gold mines that are benefiting. One of them is, with the Detour Gold acquisition, it's benefiting from the lower oil prices because they have a large open pit mine. So I think it's mostly just profit taking. Because I think a lot of people bought those dips in the royalty and streaming companies first week of March when they crashed. There was a lot of smart money that bought those dips. Because if you look on the chart, those dips did not last. They lasted a couple weeks and then they rocketed higher. And if you're a professional money manager, you're very short-term oriented, you're going to start taking profits because you have to tell your investors and shareholders in the fund, well, stakeholders, if it's a partnership, that you made really good returns. These professional money managers don't really buy and hold. They might buy something for a couple weeks, a couple months. If you have a case, this is where you bought Franco-Nevada at $85 a share and Franco-Nevada goes to, what, 140? If you're a professional money manager, you're going to sell some. And then you're going to put in your fund letter that you were a genius and you bought a lot of Franco-Nevada shares at 85 and you sold them at 140. That's what professional money managers do. They have to, it's window dressing. They have to show they made some profits. So I think this is just normal profit taking. I think smart money who is more long, in my opinion, smart money who is more longer term oriented, who doesn't believe a lot of the stuff in the War and Gold video, is accumulating on dips because those companies can adapt. They'll just make investments in the governments that treat them better, that treat capital better. Look, if these emerging markets nationalize mines, tax mines, their economies, I'll say this right now, their economies will collapse faster. Okay, we know this through history. If these emerging market, I know we have a lot of well-known people listening to this podcast. If you are running the mining sector in an emerging market country and you threaten to tax your mining or you threaten to confiscate mines, if you're worried about net capital outflows now, you just wait. If you think net capital outflows are bad now, and you threaten to do that to miners, things can get way worse. And we know this through history for decades. Capital goes where it's treated best. What these emerging market countries should be doing is lowering taxes, increasing incentives for investment from foreigners. So foreign capital has an incentive to make smarter, long-term contrarian investments into key industries. There should be, if tax incentive structure there, so capital can come in and make smarter oil and natural gas investments, smarter precious metals mining investments now. So governments would be very, very stupid to start taxing or nationalizing mines. They will only accelerate the collapse of their own governments. Look at Venezuela. Venezuela had 4 million barrels per day of oil, and they ruined their economy in spite of that. Now it's a failed government narco state relying on handouts from Russia and China. I cover this extensively. All the stuff I just discussed is covered extensively in an article behind the paywall. The royalty and streaming companies are really good at adapting to changing market conditions, as long as they don't over-leverage their balance sheets. So, if any government, by the way, the first government to start, if a government's dumb enough to do this, the first government to start rapidly taxing their mines and nationalizing their mines, you could see currency collapse there. You could see enormous levels of net capital outflows, even more than now, could double or triple in a very short amount of time. And then all the other governments are going to say, my God, I can't believe that just happened. You know why? Because they haven't studied financial history. If they would have studied financial history, they know that this happens. That when they go after the tax grab, they go after assets, things get even worse. And yes, these governments are stupid, but if they see what happens, look what happened with Ecuador for years when they, over the last like 6 or 7 years. They tried to rapidly, they didn't have experience with allowing investment for mining. Now Ecuador has a very good mining industry. But initially they had they tried to put very high taxes on mining, and it totally delayed and canceled investments, and they almost lost their entire mining industry. Now they have I would say one of the fastest up and coming mining industries because they rapidly rolled back their taxes. In the future, that's going to mean a lot more jobs, a lot more investment into infrastructure. We'll see which way governments choose. The unintended consequence is if governments try to tax or nationalize mines too much, it will accelerate their collapse. I discussed this at length in the article behind the paywall for my patrons there. My over 900, I think it's like right around 1,000 now, because I only charge $5 a month for information you probably won't get anywhere else. Like how precious metals, royalty, and streaming companies, the larger ones with actual cash flow, with diversification of cash flow, benefit when the gold and silver price gets smashed. Good luck finding that information anywhere else. Got in arguments with people that, they don't benefit. Oh, really? Franco-Nevada went market cap under $2 billion about 12 years ago. 2008? Franco-Nevada market cap under, they just started doing gold streams. Their first one, I think, was 2009. They were only doing royalties. They did a ton of deals because the paper price of gold and silver were manipulated. There's no way Franco-Nevada would have been able to grow to the levels it is now without the paper price manipulation. There's no way. Franco-Nevada's benefited extensively because they have a better balance sheet, they have cash flow, they have better margins, and when the miners, either the copper miners or gold miners or silver miners, get in trouble, Franco-Nevada can come in there and help them out and do more deals. Anyone who doesn't recognize that is probably trying to sell you something that's overpriced with probably a bad track record. All marketing hype, or worse. Okay, well, that's it for this live stream show. I want to thank everyone for listening. Thank you very much to my over 900 Patreon account contributors. It is growing a lot per day, so thank you so much. It is only $5 a month to take a look behind the paywall, and there will be more articles coming. I don't know if it's going to be tomorrow or the next day. I'm working on an extensive piece out about the global macro situation. And there might be tonight, we'll see how I feel. If I don't have a migraine after this, there might be a short commodity article in the next day or two. Thank you very much to my monthly PayPal contributors who chip in, and also people throw me tip once in a while. You can do that too through my PayPal. You can throw me a one-time tip if you want. I also take crypto donations, the top 6. So bottom line, with negative interest rate policy, for now we're not getting it, even though Wall Street traders are betting on it. Anything can happen in this environment. The Keynesian economics, neo-Keynesians and Keynesians, although I don't know if Keynes himself would have been okay with negative interest rates, he did not want people to save though. So I don't know if he would have went as far as extreme as negative interest rate policy. He might have tried some other schemes, some incentive schemes or something like that, some government tax schemes. Maybe if people spent money, they got to deduct things with more investments to their business or something. But the Keynesians do not want people saving. Anyway, who wants to save in fiat currencies that are intentionally being devalued over time more and more, and you're not getting any interest rates, positive interest rates to save? And that's why I save in physical gold and silver, personally.